think everyone else can hear. So, Jeff, it might be on your side. Okay, yeah, I just started the YouTube side of it. So it will be recorded. It'll be posted there as soon as this is over. So yeah, I guess don't don't ask if it will be recorded. It is being recorded. Barracuda, what do you mean same for all? Same as in you can't hear me or you can? All right, I'm gonna assume everyone can hear just because Chris said so earlier. So I'm gonna trust Chris, who also helped me fix something on the stream side. So I'm hoping I'll have a smoother stream this time because it's been pretty choppy in the past few streams I've been doing. All right, uh, so there's gonna be two sides of this. There'll be one sizing, contract selection. When I say sizing, I'm going to be speaking on several sides of it. So it's going to be more of a risk management, actually. So there's two sides of risk management. One, how are we entering trades? Two, how are we exiting trades, right? So um, you can enter great trades, have perfect sizing, pick the right contracts. If you're not managing them properly, it can blow up just as easily as if you're entering every size, every trade with half port, right? So there's always two sides to the equation. A lot of it is pretty psychological as well. I'll probably leave out most of the psychological stuff and leave that for another session. So this is just going to be sort of some ground rules that I use. A lot of them are pulled from Glitch. So when I first joined this group back in May, we had like the original virtual bootcamp, right? So a lot of these rules are just filtered through from him, and a few. So I'll sort of explain as I go through a few of them. There's never one finite rule, right? They're more like ranges in terms of how much risk you deploy when you're taking profits. Even the contracts you're selecting, right? It's always a range. So there's a healthy range. So I'll do my best to go over like what I would consider each extreme side of the range, and what might influence you to lean more one side or the other. But yeah, always recognize that the approach I'm listing is going to be sort of like a ballpark, and then it's up to your situation. And feel free to ask me if you want like my thoughts in the future, like just DM me or we can call or text about it. Is where on that range do you fall, right? Because obviously everyone's port situation is different. Everyone's goals with trading is different. Some people want slow growth long term. Some people are a lot more risk on and want something that they can have a lot more growth short term, right? So the approach you use is going to also vary a lot based on how much risk you're willing to take on, and what your goals are for that capital, right, that you're using. So, um, yeah, Andy, you can't hear? Pretty sure can no one hear? What? Uh, can y'all hear me now? Mm, let me see. What the fuck? Uh, damn, what is going on then? All right, still not working. Oh, okay, now it's working. All right, my bad. Shadow, you heard, Shadow, you said it's very soft. Barracuda's trolling, I hope. Sorry about that, everyone. All right. Anyways, okay, so now I have to repeat everything I just said. So the no wonder Dylan left. I guess I was muted the whole time. Um, all right, yeah. So sorry, everyone on YouTube. I'm gonna have to repeat everything I just said, but I think there's only a few people over there on that side. So for all right. So what I was going over this session is also Barracuda. You still can't hear? I think that might be just you. Everyone else seems to be okay. All right, I'm just gonna go ahead. So, anyways, the so what what I had been saying is the topics I'm going to go over today are going to be pretty varied. It's going to be sort of two buckets, right? One is going to be contract selection. So, sort of whenever we're going to enter a trade, what are some of the different contracts? What are the differences in some of the contracts we can take on the options chain? Some pretty essential Greeks to look out for. Just a couple tips on what I would do. I will also explain the range, right? So there's within contract selection, there's a more aggressive and a less aggressive with anything in trading, right? There's an aggressive profile and there's a less aggressive profile. So with everything I explained today, whether it's contract selection, sizing, trade management, I'm going to explain sort of the ranges. Um, and I'll try to give a good argument for, okay, someone who's more risk on versus risk off, how would you vary your approach depending on that? And obviously, like, why would we need that difference? Some people are trading retirement portfolios, some people are trading $2,000 fund portfolios, right? So it's the approach you use for each one is going to vary a huge amount based on how much capital you have in there, how much capital that is relative to your net worth, and what your goals are for that capital, right? Is it something you want to just slow compound over time? Is this something you just want to have fun? It doesn't matter if it blows up or not. Obviously, your approach for these different scenarios is going to vary widely, right? In terms of contract selection, sizing, when you're taking profits, how aggressive you are on your trims. So a lot of that stuff is going to vary based on your goals and what that capital means to you, right? So I'll do my best to try to cover all scenarios or just the majority of scenarios. But of course, there's always going to be probably a few people that fall outside some of these bands. So if that's the case, feel free to ask questions, right? As I go through any of this, ask anything you want. I'll just, similar to my charting sessions, right? I'll be going through a few specific topics and notes that I have, but I'll be sort of interspersing that with different questions and answering everything as people comment on the chat. Yeah, Andy, I'll share my screen in a second, but for now, well, yeah, I'll just go ahead and scare it and share it. I forget YouTube has it shared already, so it should be I guess I should be matching what I'm saying and showing on both. Okay, so I'm actually going to start with sizing, right? Because so both of these are very important, right? What contracts you're selecting and how you're sizing it. In my opinion, the way you manage your risk is the most critical thing you can do in trading, right? Even in more, it's more important than what edge you have, what system you use, what trading style you have. The most important thing is how you manage risk, right? There's some people who I've seen trade some pretty simplistic strategies, right? What people would say, oh, that shouldn't work, or that's outdated, whatever. I've seen people use some strategies that in theory are not optimal, and they probably maybe they aren't, like they're still a bit sub tier, but it still works very well because they're able to control their risk. Um, and they're sizing in a way that is very smart, risk averse, and they're managing their trades in a smart way as well. So the way you size and manage your trades is a huge can have a huge difference in your performance, right? Even if you're using what's maybe not a great system. Obviously, in this server, right, the assumption is with HeatSeeker you can get a pretty good edge in terms of your system of trading, right? So if you're able to do that, learn the reversals and all of that, we also need to make sure our sizing is in check, that we have good discipline and rules on that side. So the edge that we have is able to shine through, right? If we're not being consistent on the sizing side and we're having a lot of fluctuations in terms of how much we're sizing for over leveraging, what happens is that kills our edge, right? Where sure, sometimes it will still show through, but if we're not consistent in our approach, there's a big risk that our edge won't show through long term because of these other decisions that we're taking. Um, Even if you are still entering good setups, right? So like, I mean, the simplistic example there, right? It's like if you're leveraging your entire portfolio, or let's say even half a portfolio, you're taking very good setups, right? With HeatSeeker, you say you've understood it, you're taking good setups. There's still a risk, right, that you have two trades that go wrong in a row, right? So if those two trades go wrong in a row, everything just blows up in your face because you're leveraging so high. That's the issue here, right? So it's, can we set up a few rules and have a good structure so um, when we have a bad day, it's a small setback, but we know long term, right, we're going to have more good days than bad days if we learn the tool properly and all of that. Then if we size appropriately, we'll be able to see that shine, right? Okay, so it's actually everything I'm going to go over right now is you don't really need to look at the screen. It's not really going to be much that I'm showing here. So the main thing is like in terms of whatever portfolio you have, right? First thing you need to decide is for every trade you enter, right? What is your risk profile in when you enter it, right? So like I mentioned previously, if this is something where you're playing it a little bit more aggressively on the account, that's going to vary compared to something that's a lot safer, right? So in general, I tell people, and also one other thing, while you're learning, a lot of these rules I'll state and a lot of the values are probably best set for someone who's already more consistent with their system, right? While you're learning, I'd actually recommend you slash a lot of these values either by half, a third, a fourth, even smaller. Or what some people do is they literally just go to the smallest unit they can trade, which in the case of indexes, they're literally trading single SPY or single QQQ contracts, right? So while you're learning, you need to view it as you're just trying to use the least capital possible while you learn, because obviously as you learn, you're going to have a lot of mistakes, right? So the logic there is, okay, we're going to have mistakes. Things are not going to be perfect. We're going to miss certain clues on the heat maps. We know that's going to happen ahead of time, right? No matter what your learning curve is, there's going to be a period of time where it's not very consistent. So we might as well just lose 50 bucks a day, 100 bucks a day. Um, so then once we do feel comfortable, right, we've had this big stretch and we can look at all the data we've been doing with very small size. Once we feel comfortable, then we can go and jump up to, slowly increase our sizing until we're at the level that we want, that we desire. But there's no point to start practicing at those levels that are much higher, because if you know you're going to have less effectiveness and less consistency, that's just very high risk, right? So first thing I'll say is like for anyone that's very, very recent to the server is just be as cautious as you can while you're learning. And yes, I recognize that the losses will be smaller, also the profits will be smaller, but just realize once you're able to get that consistent and show yourself that, okay, look, for a few weeks or for a month or 2 months, I've been having success with this small size. Now I can ramp up and know that I'm gonna have that profitability. That's a much much smarter decision Then sizing normal. At the beginning, you're still learning, so things are just not very consistent. You're losing a bit more money. And the problem there can be if you finally learn the tool, but you're out of money, then there's not really much to do there, right? So that's the situation we want to avoid. We want to make sure you learn, but still have enough capital that you can actually deploy once you're ready, once you feel confident and you're ready to do so, right? And for anyone with smaller portfolio, right, where it's a bit of a concern, if you have a bit of a larger portfolio, it doesn't matter if you're just testing stuff out, smaller trades. If you do have like a much smaller portfolio, the way to test out can be either with paper trades or even like a futures account, right? Just like obviously the rules are a bit different, but the logic there, right, is okay, if we can use 50 to 100 bucks a month on a futures account and do all of our testing on that account, that is much better. $50 is one SPY contract, right? So that's a much better idea rather than risking that amount each day, right? Um, Although that's, mostly for the very, very small portfolios, it's going to be where you may have to consider going towards just full paper trading or just futures accounts. Okay. Let me wait. Sorry, let me see. Yeah. So even people with large portfolios, I know there's a few people that they preach, and Dylan's pretty big on this actually. So they preach just paper trading, right? And if you can't paper trade and do well for a good chunk of time, there's no business deploying real capital. Now I realize the issue mentally, right, is some people are not able to treat paper trading the same as actual capital because there's not actually any risk involved. But if you're a person where you can treat it the same mentally and just really take it with discipline and, you know, start a paper trade account with the same exact amount of money that you would have in real life and treat it as if it was real money, if you're able to do that, then it does have a lot of value, right? Because it allows you to sort of sandbox, right? And you can test everything out. You can see which plays work best, which setups don't, and test all of that out with obviously paper money. And then you can start to iron out, all right, maybe those trades, once I move to actual capital, I want to avoid these kind of trades. I want to make sure I'm taking only these kinds. So it can be a huge learning experience, right? And even once you are more consistent, paper trading still has its value, right? Because we never want to get complacent, right? And just be, of course, we want to have a system we can replicate, but that doesn't always mean that we stop learning, right? So then what I always tell people is even while you're still doing better, if you want to test out new things, it's still useful to have that paper trade account so you can test stuff out, right? Let's say you're playing normal options and you want to test doing spreads, or if you come from futures and you want to test doing options, like there's always value in having that paper trading account. So just on the side where you can experiment and tinker with any new approaches, new setups, new kind of trades. So that's always going to be, for me, in my opinion, that's always going to be something that's very useful. Okay. Yeah, so that was a bit more generic stuff. Wait 1 second. Let me see over here on YouTube. I got the ultra. Yeah, yeah, I have like I don't actually know the dimension, but it's for like sim racing, so that's why it's so wide. Well, it's also nice for charting though. Uh, yeah, check. So exactly, right, is making sure you have a consistent stretch with a good win percentage, a good average percent per win, that your wins are outweighing your losses, right? And making sure all those numbers and the data backs it up before going on to like higher amounts of money. Because um, yeah, I think of it that way, right? Like you need to show yourself the data that once you scale up to higher amounts of capital, that you'll do well, right? Um, Another thing I'll say is like obviously is to protect our own capital, but while doing this, a lot of times what will also happen is your confidence will increase, right? And a lot of times, the confidence you have in yourself, in your system, in the tool is very important, right? Trading is obviously a very mental game. So if you're able to build that confidence ahead of time with low risk, like low capital risk, that will help you a lot once you start pushing a little bit more capital to have that confidence and to know, okay, this is a system that I've tested rigorously and I know it works, right? All right. So in that case, I'm gonna go over. So let me give me a second here. Now that I think about it, I think I did have. some kind of document I made once with some general guidelines. So I may pull that up and then I'll just edit it as I go along in case any of it is like outdated or I don't agree with it anymore. Yeah, I'll show this one. Spectra, I'm gonna start printing screenshots of. Yeah, actually, I recommend that. A lot of people, what they'll do is they'll use like post-it notes and different things like that, where they have all the big hacks or like the quick tips. Or what a lot of people also do is they'll print a checklist of things they need to go through, right? Um, so yeah, oh, having whether it's taped to the wall, post a note on your monitor, a notebook, whatever it may be, that's always a good idea. It's having some kind of checklist and a couple of just base rules that you can go through each time before you take a trade, stuff like that, right? Okay, so yeah, getting into some of the rules that I actually use. Um, so again, these are some of the rules I use. I'm going to explain some of the differences I would suggest or that can be taken as I go through. So I'm just going to go by bullet point, honestly, and then I'll just take questions as they come along, and it should give you a good, like a rough idea, right? Okay. Uh, yeah, Chris. Yeah, actually, I found one last thing. I found a lot of times like a physical copy actually is worth a lot more than a virtual checklist, right? So whether it's a checklist or set of rules, physical copies, for some reason, we treat them with a lot more respect, is what I've found, whether it's just a sheet of paper on your desk, taped to the wall, posted, whatever. I've actually found that it's a lot more helpful. Um, I think even Glitch a while back has some picture of like his ideal trade, and it's just handwritten notes on notebook paper. I don't know if he still uses it, but I remember he sent that out quite a while ago, and it was something that he said, yeah, keep it simple and make sure it's like the core rules, but it's something that can be very valuable. All right. So getting into like trade sizing management. So yeah, first thing on sizing, right? Of course, is how much we risk per trade. I generally stick to around 5% risk, right? So of total portfolio, this is assuming it's not like a challenge port, right? Obviously, on a challenge port, I've seen people go up to like 20%, 50%. That's a different scenario. If we're assuming this is a portfolio that you don't want to blow up, right? That you want to keep it go consistent, 5% is a pretty middle ground risk per trade, I would say. Um, if you're a bit more on the aggressive side, I would go up to maybe 10%. I wouldn't go past 10%. So like when I do challenge portfolios, I do 10 to 20%, but usually around 10. But I usually stick to 5% if it's my main portfolio, right? What I will say is if you have a much larger portfolio, so I've spoken with a few people, it's like, six figures or much higher, they actually size even smaller. So they'll be sticking towards 1%. Um, So again, it's dependent on your situation, how risk on or risk off you are, but 5% is a good ballpark, and I would say in between 1 and 10% is probably a good idea. Once you're comfortable, right? Once you're comfortable with the system, you can replicate it. That's the range I would recommend. Um, Now, something Glitch does that I actually don't do is he does dynamic sizing depending on his confidence in the trade, right? So if he's more confident on a trade, he'll probably risk up to 10, maybe even 15%. These numbers are from memory, so um, sorry. Oh yeah, Remy. Yeah, that one. I think it's that one. It's a really old picture, but I'm pretty sure that's what it is. Um, but anyways, so Glitch does some dynamic sizing, right? Where he's like, okay, A setups are going to be 10% of my portfolio, B setups 7.5, C setups 5%, right? So he sort of has like this scale, right, where it's each type of setup is a specific percentage of the portfolio. So what I recommend is either do that, or if you're going to do a fixed percentage like I do, essentially what I do is I cut out all of the lesser tier trades, right? So I'm only taking A setups and I'm just doing them all at 5%. So I do that mostly because I do have a slightly smaller portfolio. As my capital increases, I'll probably add, okay, I'm doing 5% for A setups. I'm going to do 2 to 3% for these B setups, right? But you should have that sort of dynamic sizing where it's like, okay, and the important thing there is you need to define your buckets, right? What is categorized as an A trade? Because it shouldn't just be like vibes, right? It should be some kind of metrics that you're using in terms of, for example, on the indexes, right? If we have two floors aligning across two indexes plus some upside volume, maybe that's an A setup, right? Plus a double bottom, double top on the chart. Let's say we're missing one of those things or two of those things, then you drop it down to a B setup or a C setup, right? So you need to sort of decide what your buckets are and what features of each setup it has in order to be an A setup, B setup, or C setup. Um, so that's also going to be a very important list to make for any of you that are, still coming to grips with the tools. This stuff you can start to think about, right? And a lot of these details, whenever you journal, it's pretty important to be a bit detailed, especially at the beginning, because when you're trying to categorize what is an A or B setup, it will also help to look at the past month, 2 months, 3 months, whatever time period, and look back and say, like, look, okay, here was a scenario where I was playing off of a single floor, and here's a scenario when I was playing off of a double floor. And you can basically compare, okay, all of my single floor plays versus double floor plays, what's the difference in success, right? And that can also help you decide, is it an A, B, or C setup as you do that. Last thing I'll say is like most people also have like a lotto play sizing. That is usually going to be like 1% or 0.5%. So it's going to be something way, way smaller than most of your average size, right? Um, so those I honestly wouldn't even like I honestly I don't take lottos anymore, right? I used to when I first joined, right? I was maybe a bit too risk on. So, but I used to take like some of the earnings plays and some of that stuff. I don't recommend doing that too much, especially if you're learning, and especially if you have a smaller portfolio. So later on, if you have a larger portfolio, you're more comfortable. It's fine to do so. Just make sure, again, you're sizing that very, very small. It's always going to be the best way to approach that. Okay, so that's terms of sizing for per each individual trade. The next comment is going to apply a lot more for people who are doing swings, right? Because when we're doing index trades intraday, most times we're doing a single position at a time, right? Where it's like, okay, we're either biased upwards or downwards. Once we enter, obviously some people scale in some of that, but you're still roughly you're taking a one bias play, right? And then once you cut that, then maybe you might flip bias, but you're not usually having like three separate positions in terms of like calls and puts at the same time because it doesn't really make sense, right? But on the individual side, one of the big risks we can run into is we come and watch list. Let's say we watch list tonight, right? You scan the maps, you scan the charts, you find a few different good setups. If all those setups offer an entry tomorrow, the big thing I'll warn against is taking all of them, right? If you start taking every single trade, even if you're sizing 5% per trade, if you take 10 trades, you're still risking half of your portfolio on a single day, right? Um, so I have a rule where I don't want to have more than like a quarter of my total portfolio risk. I can't actually remember the percentage that Glitch uses. I think it might have been 30, no more than 30% total. But anywhere between 20 and 30%, I would say is pretty safe if we're talking options, right? Obviously, if we're talking shares, that's a different question, right? Like shares, you can usually leverage a bit higher. But in terms of options, you usually want to be risking, let's say, to one fifth to one third, if we're talking short dated options, right? Again, if some of this is leaps and some other kind of like more longer term plays, this is probably different advice there. But since the majority of this group and myself as well don't do too many long term um, plays, like it's not as focused on that side, then I'm going to keep these rules at least focused more towards short dated things, and short dated being probably a couple months or under. Oh, 1 second, Andy. So is the tool meant for? So it's meant for. I think it's strongest on the indexes intraday, but it can definitely still be used for weekly, biweekly, monthly, bi-monthly, even up to half year leaps. I will say well, a couple things here. In the current iteration, you only have 5 weeks of data. A couple tickers are monthly expiration, so for those you do have more stretched out, but for the average ticker, right, you have 5 weeks of data, so it's mostly helping you pinpoint a very strong entry point. And then if I want to play very, very long term, what I've done is that has to come a bit more from your charting thesis, right? So of course, As time passes, you can keep checking the heat maps to sort of get an update for how it's feeling. Like, are we still continuing to be bullish as time goes on? But in terms of like my overall thesis of like, is this a good support resistance level? What I'll do is I'll just flip to the chart, usually go to a more macro side, right? So I'll go to the monthly, weekly or monthly. And if my thesis looks very strong there, if I see a very strong short term, like if I see a strong setup on the heat maps for the following month, plus a very strong argument long term on the chart, then I'll go ahead and take that play, sometimes even as a leap, right? So just try to pair it with like think of it that way of like, even if you're taking a leap play, if you get a very strong first month on it, that's going to help you out a lot, right? So that's sort of what we're aiming for is using the GEX and VEX. Can you get a very strong entry if you're doing more the leap side or even shares, right? But I will say like the tool excels most on the shorter dated. But the other comment I'll make here is the update that's coming in terms of the updated website UI will actually allow us to look at more expiration dates, right? So right now we're limited to 5, um, but that update will allow us to be looking at, uh, I can't remember the exact amount, but I think it's at least double, if you'd like, of how much expirations we can look at to the future, right? So I think the whole like longer term swings and even leaps is going to become a bit more accessible once that new feature comes out. I think essentially Glitch had to restructure. Well, Glitch and the team had to restructure a lot of the back end to be able to handle more load in terms of expirations, tickers, and all of that, and strike prices as well. I think is also included. But I think once that comes out, that will be a huge benefit for everybody. Where especially people who are a bit more bogged down day to day, like let's say you work in healthcare, for example, that will be a huge plus that we can play a bit more long term with more effectiveness using the tool. Okay. Yeah, I kind of went on a tangent there. All right. But so the main point is like if you're doing swings, like weekly swings, monthly swings, make sure you're not risking too much capital at the same time, right? And also a big point there is also make sure you're not over leveraged in the same direction, right? So if you're entering 5 different swing plays, right? If they're all calls, if they're all calls, especially like let's say they're all in the tech sector, they're loosely tech based or computing or cloud, whatever it may be, make sure to not over leverage in either direction, calls or puts, and also not over leverage in a single sector, right? Because what may happen in those cases is if we have a strong sell off like we had today, like we've had a few strong sell off days recently, if we get a very strong sell off and you're only in call plays, right? Then you're going to run into a big issue where it's like, okay, even if the setups look quite strong, the overall indexes are going to move the market, right? So if we're selling off super strong on the indexes, it's going to be very hard for whatever setup you saw, even if it looked quite bullish, to really push, right? Sometimes they'll be quite bullish and so they'll stay afloat, like they'll stay sort of break even or they'll not die off as hard as the rest of the market. But it's always a good idea to make sure you're not only in calls or puts and that you have a good variety there, right? So sometimes we can read the macro. So for example, the after the tariffs, right, last year, pushing all the way into like November, December, we were in a pretty bullish market. So in those cases, it's okay to bias a bit more towards the call side. But especially like in a period right now where we're at all-time highs and it's a lot more variable, I would be very careful to not leverage too much to the call side or too much to the put side, right? And try to have a good mix when you're trying to define these setups, right? And so I had a rule. I think the rule I used to use, right, is like if I'm in three, I think I would allow a max of 3 plays in one direction, right? So if I was already in 3 positions to the call side, I would make sure any other position I take is going to be towards the put side, right? I, that's a personal rule. I don't think Glitch does that one, but Glitch pays close attention to the indexes, and he makes sure any plays he's taking are not opposing the indexes, because obviously those will have quite a rough time. Okay, let me keep going down this list. So, oh yeah, so this sizing point, I'm gonna delete that. I think I went over that. Well, let me just add the point here of like dynamic sizing based on setup A, B, C. So I wrote this document quite a while ago. Okay, yeah, obviously at this point, this is just on the setups you select. That's not actually a risk thing. Let me see if there's anything else based on risk. I don't believe so in terms of like entry, but now I want to spend a bit of time talking about like once you're in a trade, how can we best manage it in order to not, I guess how can we best manage it in a safe way, right? So I think the key for everyone to remember here is when we're trading in this style with this tool, with this like reversal method, right? If we're able to time the moment of a reversal quite well and we're able to buy calls or puts right before the candles flip direction, a lot of times what will happen is as price is dropping, call premiums will be a bit beat up. As soon as we get that first green candle, right? What will happen is that will not be the case anymore, right? Like the premiums will be jacked up quite a bit, right? And this is why a lot of times if you realize when price drops pretty hard, if you enter calls before that first few green candles, it'll be a lot cheaper. And then even if we get a few candles and then stabilize and chop, and we're still in that very similar region, that first drop and when you get the calls there, it's still going to be cheaper because once we start getting those first few couple candles, and even if we drop a bit after, chop around there, um, and I'm saying like in a quick time frame, right? So it's before theta has kicked in. Um, the premiums will still have been cheaper on that first initial drop, right? But the point is, okay, if we're trying to catch that initial flip, right? What happens is a lot of times our entry, if we're pretty picky about it and we get a good fill, is we can be up a good 10, 15, even 20% by the time that first candle's like closed, right? Like that's the whole point is if we catch that flip point, we have this huge boost in profits already where everyone who's waiting for confirmation and waiting for those first couple of green candles, they're getting in at a point where we're already up 30, 40, maybe even 50% in some of the extreme cases, right? But let's say 20 to 30%, just in a general sense. Um, so where they're starting from 0% and they've just taken entry, we're already sitting on a nice cushion, right, of some profits, right? And that's the whole strength of this strategy. And that's the whole reason that a lot of times when we're catching these reactions off of strong nodes, we actually don't need a massive move, right? Because we're catching that flip point. Whether we get a full reversal or not, we've already secured that 20, 30, 40%, and we can already trim there, right? So what I always tell everyone is like, okay, if we're getting a good entry, we're getting that initial flip, we might as well trim and protect a portion of our profits, right? And we're selling a portion at usually I target between 30 and 50%. People who are more like on the scalp side are a bit more cautious. They may even drop towards 20. I really wouldn't drop below 20. I do know a few people do trim like at 10, 15%, like very quick. But I generally try to stick it out until at least 30 myself, unless I see something that looks very concerning in terms of the price, price action or the heat maps. Then there's cases where I will cut earlier, but usually I'm holding for at least 30 to 50 as my first trim, right? And so the logic there is, let me see if I can pull a trading view. This may be a better way. All right, so the logic here, give me a second here. Let me drop down to, let me see if I can sketch this out. Yeah, I'm just gonna sketch a fake scenario. All right, so logic here is like, say we're in a downtrend, right? So as you know, we're gonna be making lower highs, lower lows, lower highs, lower lows. Um, if we're targeting an entry right here, like let's say at this point, right? What is the whole benefit of playing the reversal, right? Is we don't know if when we catch this entry, right? At this point, we don't know what's gonna happen, right? But if we've caught this initial reaction, what we can do is trim at this point, right? So if we're selling out at this point, when we're up 30 to 40, 50%, what happens there is if you sell a chunk of your position there, you've already secured some profits. Anything that's remaining in terms of contracts can be left on, right? And now it doesn't matter to us if the trend continues downward, right? So there's two situations here. The trend just continues making higher or lower highs and lower lows. The other scenario is if we break the trend, right? So if we start create a higher high and we break this level here, um, obviously for us that'll be a huge plus, right? That means our runners will if we get a full trend reversal, our runners will have a lot of profits, right? But the whole point here is if we're trimming at this level here, right, before we even know if this is a confirmed trend reversal or not, we've already caught the profits that we need in this initial bounce, right? So obviously, if the trend continues, then that's fine. Our runners will just get hit break even at some point. Now, if the trend full reverses, that's why we have the runners, because now, we have our initial trim at 30 to 50%, let's say, and now our runners are really going to have a huge move, right? Where we can go up towards 70, 100, and, further, right? So that's the main logic here is we will always want to make sure that we're trying to cut. And if you trade in this way, we won't be dependent on this trend reversal, right? Because a lot of people, when they trade, they're looking for that change in structure, right? And that's sort of the whole basis, because if that change in structure doesn't occur, their position is, the trade's not going to go as well in their favor. But a lot of times by catching the true bottom, or at least attempting to get as close as we can, even if we don't get the full trend reversal, we can still have a good trade, right? So that's always going to be pretty important. Um, So yeah, so when I'm in any kind of trades, right, I always trim. So this is actually, I don't trim based on the chart or the heat maps, right? Obviously, if I see something concerning, I'll trim earlier, but usually I'm trying to target 30 to 50% because I'm playing that reversal. And then afterwards, I know the runners. When I'm managing runners, then I'm starting to look at different chart levels, different levels on the heat map, and I'm starting to anticipate, okay, if I took calls, where are the next ceilings? Where are the next ceilings I can see on the heat maps? Where am I seeing any kind of potential resistance on the chart? And that's when I really start to monitor both and try to establish when is the best point to sell, like where are my targets here, and all of that. But that's mostly on the runners, right? Usually the initial trim has already been performed by then, right? What I'd also recommend for smaller portfolios is as soon as you take that first trim, put most of or put your runners on break even stop loss. The reason for that is that way you secure a green trade, right? So if you have a massive portfolio, right? So if, like, let's say Glitch is taking 500 contracts of whatever, right? He can trim 400, 450 contracts at 30%. I'm just inventing numbers here, actually. I don't know exactly how he manages his trades, but let's say he trims 400 contracts at 30%. Everything left over is already a free position, right? Because he's trimmed the big bulk of his position at 30, 40%, and that's enough to cover the cost of everything that's left over. If you're in a small portfolio and you're trading three contracts, that's not the case, right? Because if you sell if you trim two contracts at 30%, that doesn't yet make up the cost of that third contract. So you can't truly leave that runner sized for zero, right? Whereas someone with a much larger portfolio can. So if you're dealing with a much smaller portfolio, you're going to want to make sure that you're putting a break even stop loss. I usually do it like once they hit 30, 50%. I go ahead, I trim, and when I do that first trim, any runners left over, then I go ahead and slide in that break even stop loss, right? So that's the system I use. So then it's just anytime I get a trim, I know that that trade is going to be green, right? Obviously, I don't know how green it's going to be because I don't know if that runner is going to go for a home run or not. But I'm ensuring it's a base hit, right? So that's really the point I want to make there is just, make sure you're keeping those trades green when you have them. Let me get some water. Sorry. Yeah. Okay. And I think I already explained. Yeah. With any runners, make sure you're looking for any potential nodes that could roadblock the path up or down, any chart levels, support resistance levels, potential double tops, double bottoms. Same rules we look for on the entries. When you're in a trade and you're trying to manage it, you should be looking for the opposite, right? So if you're in calls and you see any argument coming up for puts, that's a good spot to trim, right? Because if someone can justify an entry opposing you, that means it could happen, and it's a good idea to say, okay, maybe I won't sell the full position, but at least sell off a few of those contracts that you have left, right? Um, okay, let me see. So I think those are most of the rules I have here. Let me see, 2 3. Okay, so all of that is basically trade entries, sizing, how I manage while I'm in the trades. Obviously, there's going to be some nuances here, right? Like if you're trading a much more aggressive profile, maybe your first trim won't be at 30%, it'll be towards 50, right? And I've seen even some people they target 100%, right? Um, but I would really only save that for like pretty aggressive, like if this is maybe more of a challenge account or if it's, some kind of very aggressive portfolio you're running. Um, the only ground rule I'd have even on those accounts is once you hit 100% in profits, you should be at least halfway out of the trade, right? Because at that point, anything left over is a free contract, right? If you still have your contracts at 100%, everything else is free. And then it doesn't matter if they go straight to zero or whatever, you at least have secured a break even trade at that point, right? And if you sell half at 100%, and you put break even on the rest, you've secured a 50% trade, right? So again, the sliding in a break even stop loss is usually going to be a pretty good idea, um, at least while you're starting out. And if you're not having, if you don't have a massive portfolio, I would do that for most of your trades once you do that, once you execute that first trim. The last thing, well, I should have led with this. For anyone very, very new, the big assumption in this server is that you're sizing everything for zero, right? So all the risk you're doing is when you're in a trade, right? We know that sometimes these nodes will get wicked pretty hard under. Sometimes we'll chop for a while before getting a full move. So by sizing for zero, you're essentially not panic selling out of a trade, is the reason for doing that. So all of these different, I guess all the scenarios I've been going over, right? It's assuming you do that, right? So even if you're down quite a good chunk, if your thesis is still valid on the chart and on the map, so if you're still hovering at those levels that you want to hold as support, um, then you're going to want to hold through and see, okay, if my thesis is still valid, I'm going to give it space and time to play out, right? So after a lot of time and more experience, sure, you can start to put some stop loss on it, but at least while beginning and still coming to grips with the tool and this sort of way of trading, your entries are going to be a bit mistimed sometimes, right? So playing without a stop loss is going to help out there, right? So again, sizing is going to matter hugely when you're doing that because if you're gauging the percent loss, like if you're looking at, oh, I'm down 50, 60, 70%, obviously you may tend to overreact, but the reason for sizing small is so you can look at that and say, okay, I'm not worried. My thesis is still there. I'll let it play out, right? And I've seen contracts go from minus 90% to plus 90% on one day, right? Within an hour. So it's the, if the thesis is still there, it's going to be a case where with time you'll start to build a trust and confidence in the tool and in the system. But I've seen some pretty crazy swing, like turnarounds and flips on profits, both on day trades and even swing trades, right? Okay. Any questions there before I hop over to the contract selection stuff? Skylight, Skylight down. I don't know. Maybe. Maybe it's just my computer's lagging again. Wonderful. Yeah, Skylight might be down. It's not loading. All right. uh, okay. So on the contract selection app. Oh, did they just release? Yeah, I think Glitch sent an announcement. Wait, one second. Let me check this out before I say anything else. Oh, I didn't know he was dropping this today. That's exciting. Oh, okay, but it's still not the updated terminal. Okay, so that must be coming out later. Right. Yeah, so as Glitch said, everyone, any way to increase resolution? Phoenix is blurry? I thought Discord added like 1440p streaming now. It should be 1440. Gabenator, what is the unified terminal at? Oh, so at least for now, it's just going to be in it's basically it's where he's going to aggregate HeatSeeker, FlowSeeker, Nexus, some of the agent stuff, I believe, and some of the support and help tabs. So it's just going to be a new website where everything is accessible through the same website because right now HeatSeeker is sort of just its own website. So instead of having HeatSeeker, FlowSeeker, Nexus all be different websites, he wants it to all be on one terminal, right? So that's sort of going to be, with your one profile, you can access all of those different things. Um, I don't know the exact release dates of like each portion of the terminal, but I know the HeatSeeker part of the terminal is probably going to be released in the next week or two before the boot camp in New York City. And yeah, Admiral, that's what I'm about to go over, the contract selection stuff. Okay, so in terms of sizing, it doesn't seem like anyone has any questions. So I'll just go ahead and start on this contract selection stuff. All right, so on the contract selection side, right, this can also make or break a trade for different reasons, right? If we're selecting contracts, again, everything in trading has a more aggressive and less aggressive relationship, right? Where it's a sort of um, oh, how do you say this? I'm blanking on the word. Like a trade-off, right? So I'll go over my approach and I'll sort of give the pros and cons and sort of how you can skew it one way or the other if you're more aggressive or less aggressive, right? For contract selection, right, the issue with options is we're always battling time, right? And for a lot of people, we're also battling cost, right? If the contracts are too expensive, then it's going to be very difficult for us to even enter a trade according while following our risk parameters that I just mentioned, that I just went over, right? So, one second. All these people are asking. Yeah, Phoenix. Yeah, Glitch. He'll post it to his YouTube. Barracuda. No. Well, Barracuda. I think there's an online option, but like, still, there's a cost involved there. So you'd have to DM Glitch about that. I don't know the details, the full details there. Okay. So in any case, when we're looking at options, right, there's always going to be a trade-off. So there's a couple different things that we can look at that give us a few clues on that trade-off. Um, so yeah, let me just go in here. I'll just click a random contract. So the big things you want to be focusing on, obviously you have the price of the contract. I think that one everyone is probably familiar with, sort of like the bid ask. So one big thing, right, is try to make sure you're trading high volume tickers that have a tight bid ask spread. If you're trading low volume tickers, so like let's say I think Twilio, Take Two Software, like stuff like that, sometimes they'll have pretty wide bid ask spreads. If you're dealing with a wide bid-ask spread, never market fill because you're basically going to enter the trade, look at your position, you're going to be down 10, 20, 30% immediately. Most times with these wide bid-ask spreads, you can bid towards the low side and get filled, right? You may have to wait a little bit, but I would most of the times bid towards the low side. Even on stuff with a tight bid-ask spread, I would still not order market order, right? Because the logic there is price will always be fluctuating, right? So it'll always be fluttering. So a lot of times you can get a lower entry point just through getting a limit buy and saying, all right, I'm going to try to get 50 bucks, 10%, 20%. I'm trying to knock off X percent of the contract value and get in there. And then if we get any kind of wick, either above or below, whatever level you're trying to play, you'll get filled on the wick basically, right? And so these limit buys will help you get closer and closer to that true low of day or not low of day, but like low point of the swing of the bounce or the high point, right? If you're taking puts. Um, yeah, so that's some stuff there on the bid ask spread. All right, so in terms of, I'll go over the volatility first before I go over some of the Greeks. So the volatility, the there's a few rules here, right? Like this is based on what ticker it is, right? It's very dependent on the ticker, the market conditions at the time. It's also dependent on upcoming events, right? So of course, any ticker before earnings is going to have very high volatility. And the way you can think of this is sort of like a scale factor. So the higher the volatility on a contract, the higher the premium. The big risk here especially for something like earnings, right, is you can have a volatility crush, right? So prior to earnings, so let's say earnings is tomorrow morning, right? So at 3 p.m. today, volatility is going to be sky high. So most contracts before earnings are 150, 200%. I've seen it all the way up to like 300, right? So the issue there is they are ramping up the volatility. Implied volatility has risen because that upcoming earnings decision that is either going to push the ticker price, much higher, much lower, potentially, right? So the implied volatility has risen just on the potential that price can move very violently, right? So you're going to have a pretty high percentage there. The issues after earnings, right? The after that big event, the big catalyst that was causing that volatility to increase, of course, that volatility is going to drop back down and reduce a lot, right? So the term volatility crush is okay. Now that that event has happened, whether it's earnings, sometimes it happens around NFP, FOMC, different events like that, or if they have, sometimes they'll have like these keynote speeches for Apple or Microsoft and stuff like that. So sometimes the volatility will ramp up leading into those. Once that event is over, right, obviously the implied volatility is going to drop back down drastically. So your contract will lose a lot of value. It'll lose some percentage of value regardless of where the stock has gone, right? Even if the stock has gone in your favor, if it's gone against you, if it stayed flat, your contracts are still going to lose some value due to that, right? And so that's the big risk with playing earnings is one, we have no idea how it's going to react to the earnings, right? Like there's many times they beat the EPS, the revenue, and like all of that, and the stock still goes opposite way, right? So of course there's that risk, but the other risk is like you're also just battling that IV crush. So you not only need to guess which direction the stock is going to move, either upwards or downwards, you also have to predict, sorry, not predict, you also have to get a large enough move that the increase in your contract price, um, due to the actual move of the stock, is beating the implied volatility drop, right? So that's always the big risk with playing earnings, right? And why generally you'll want to avoid it unless it's like a very, very small position. Okay. Oh, thanks, PK. And Larold, yeah, yeah, absolutely, right. Yeah, I'll go. Yeah, whenever you're trying to limit buy, it's if you don't get filled and the play goes your way. What I've been telling a lot of people recently is like it's very frustrating in the moment, right? You're gonna miss trades, whether it's due to limit buys being too aggressive or just you not spotting stuff. You have to also get used to that sensation of missing trades. And another thing I've told people recently is like when that happens, of course, it's very discouraging that you missed it, and that can be something you get very frustrated about. The one big positive about it, though, is that means your thesis was correct, right? Obviously, you didn't get into the trade. You may have to tweak your entries. That's something to like just look at in the future while you're recapping it. But that means your thesis was correct, right? You're just a bit off on the entry. So that's perfectly fine, right? Entries is a very tricky thing to get down. But if you're able to see that your thesis and your bias is correct over and over and over, that should be building your confidence, right? So a lot of times, even trades you miss can be a very good thing where you say, okay, look, I missed it, but obviously I read the map perfectly. I read the chart well. And so, future comes around. I know this setup is something that I want to take again, right? Same approach. And then eventually you get filled on some of them, right? But it's better to have a couple trades with very good entries rather than be trying to get these early entries on way more trades and just dealing with a lot more drawdown, right? So the goal here is like, can we slowly try to get to a place where we're having very little drawdown? Obviously, there's always going to be some drawdown, but can we at least try to reduce that drawdown that we're seeing as much as we can, right? Okay. So yeah, that was the implied volatility. So yeah, now getting over to the Greeks, right? So these are all for first order Greeks. I'll go over actually only the first three. The Vega and Rho is not really much. Uh, they're less important, right, on a day-to-day basis. And even the Gamma is. Some people look at it a lot, but it's not. Most times you'll be able to focus just on the delta and the implied volatility, and that's enough to select your contracts, right? So that's actually those are the only two values I look at on a contract when I'm trying to decide what to buy. Well, and the price, obviously. Okay, so in terms of the delta is telling us for every dollar of the underlying price moved, how much is the contract price going to increase, right? Another way to look at it is how probable that contract is to finish in the money. So some people look at it as like, I think some people actually just take it as like a straight percentage, right? Where it's like, oh, like a 42 delta means there's a 42% chance that we're going to finish in the money. Um, I'd have to double check if that's actually true or not, or if that's just something like a simplified way of looking at it that some people use. But the main point here is the deltas increase as you get closer to in the money or at the money. And once you start going in the money, they continue to increase. And as you go further out of the money, the deltas increase. They drop drastically, right? So there's always this trade-off because obviously a higher delta is going to be a lot healthier. Um, but what's the issue? Obviously, higher deltas are also associated with higher contract prices, right? So for a lot of people, especially where the portfolio size is restricting what trades you can take, you're trying to go far, further out of the money so you can actually afford the play, right? But then the issue is if you go too far out, the delta is going to be so low, it's then going to be something that's very, very unlikely to finish in the money, right? So this trade-off sort of between contract price and delta is one that we always kind of have to juggle. The good midpoint that Glitch recommends is around a zero point 0.3, so around a 30 delta, right? Where those will tend to be the contracts that are usually enough on the cheap side but they're still probable to finish in the money because, assuming we're taking a good setup and everything, right? That they'll move quite well and not lose so much value due to theta as well. So at least a 30 delta is the rule of thumb that we use, that most people use in this server. If you have a much larger portfolio, I know plenty of people who actually go way higher. So they're looking for deltas of zero point 0.5, even 0.6. But for those of us with smaller portfolios, we're probably looking for deltas between zero point 0.3 to zero point 0.4, right? And again, these are ballparks. Like if you just sit there staring at the contract while the market's live, the deltas are also fluctuating. Same as the contract price. All these Greeks are going to be fluctuating. Everything's going to be it's going to be live, right, and changing as price moves around. But you ballpark a zero point 0.3 contract, right? So again, it's maybe 0.3, 0.32, 0.28. Like there's going to be a bit of fluctuation there, but you should be ballparking for a 30 delta, and that will give you sort of the healthiest movement and a more affordable price, right? If you're able to size a bit heavier, you can probably go a bit safer, right? And say, okay, I know the 30 delta is at, so let me see in this case, right? A 30 delta might be up here. Actually, it's a bit higher, maybe up towards 6.8, too far, 6.880. Yeah, so right, 6.880, we have a 28 delta, 6.875 is probably right around 30. Yeah, 31. So obviously, if you're a bit more risk averse, you want to take a safer play and your portfolio size allows it, you may look at a 6.855, right, and say, okay, I'm going to take a 40 delta instead. But as you can see, obviously, there's quite a sizable difference in contract price between them. So again, this is sort of the big trade-off you're going to be taking is um, based on what delta value. Obviously, closer to the money is always going to be a bit safer. Like the contracts will not lose as much value as quickly due to theta. So chop will kill a further out of the money contract a lot quicker. But if we're timing the reversals well, in theory, any of these can make money. Um, but of course, we never know the timing of how the stock market's going to move. There's always going to be a bit of uncertainty there. So that's the reason we don't go for these super far out of the money contracts with these super low deltas. Okay. The other thing I'll say is this gamma value, right? So this is something I think actually Glitch mentioned it today. Is as I think by definition, what the gamma means is every time the a dollar you see a dollar increase in the underlying, um, the gamma is how much the delta will increase by, right? Where the delta is how much the contract price will increase by, the gamma is how much the delta will increase by, right? So I think Glitch mentioned it today. Like sometimes he'll go quite far out of the money, like sometimes a little bit more aggressive, um, if he expects a very large move to happen, right? And the reason for that is if you get the move to happen and your timing is very spot on and your contract's out of the money, what happens is you get this cycle where the gamma and the delta values sort of like ramp each other up. So actually, the contract doesn't increase linearly; it's actually a bit exponential, and you get more of that effect if you're going further out of the money, right? So I'd have to find the message, and maybe I can try to link it. Maybe I'll try to link it in the video description or something. But there are times where you can go a bit more aggressive if you're expecting like a very large move, or you're expecting that move to happen very suddenly or very rapidly, and taking effect of that sort of gamma delta like loop can sort of like blow these contracts up and make it quite an exponential gain, right? And a lot of times this is why you'll see during MOC, so market on close last 10 minutes or very late in the day, if you get the direction right, obviously the timing at those in those moments is very condensed, and that's the reason those contracts just they explode, right? Even though the moves are very small in terms of the chart, we'll be moving like $5 on SPX. The contract increases and drops in premium are drastic, right? Um, just because they're rapidly going from in the money to out the money and just having these huge fluctuations, right? And that's something that you see that's a product of options, right? Obviously, on futures, end of day doesn't matter. Like futures is a linear increase and decrease in profits and losses, whereas options it does get quite exponential, right? Okay. One last thing I forgot to mention on implied volatility. You'll also want to be tracking these. I mentioned the whole risk of the IV crush. Always be tracking what the contract volatility is, right? I generally won't play any contracts with IVs over 100%. Um, there's a few tickers that's impossible, right? Like so, for example, a lot of times Quantum will never go below 100%. OKLO had a long period where it was never trading below 100% IV. So there's some contracts that are just more volatile in nature. As long as it's not leading into some event that'll have the risk of an IV crush, I'll still trade those, right? But for most contracts, I'm looking for the IV to be under 100% if I'm going to go ahead and take a play on it. But um, yeah, so that's probably one comment I'd forgotten to do there. Let me see here. Okay, so in terms of Delta IV, that probably whenever everything that I look at. The last thing I'll mention in terms of contract selection, before you can go to any other questions, is of course, these are all rules sort of used just based looking at the options chain. You can also use Heatseeker to your advantage when doing this. So, for example, I'm just going to flick to a random ticker and see if I can find some kind of. Yeah, this is good enough. I don't. It's probably not like the best example, but we're just going to make something up for the case, for the sake of argument. All right, so, and I'm doing snipping so I can actually draw on this. Oh yeah, my computer is lagging for sure. What the heck? All right, so say we're playing as ASTS, right? And we say, okay, like we have a strong floor down here, maybe we have a ceiling up here. So I'm expecting if price taps 80 that we can play some kind of bounce, right? When selecting contracts, right? Obviously, you're looking at the deltas, the IV, and all of that. Assuming all of that looks good, another thing you can use to consider which strike you actually buy is the heat map itself, right? So if and this is an issue I see, especially with like a lot of new members, right? If you're targeting a move, a push off 80 and a move towards, let's say, 90, right? A lot of people, they'll say, all right, I'm just going to buy 90 calls. What's the risk here? These nodes are ranges, right? So even if we push all the way to 90, the risk here is if price ends at 89.5 and you're trying to hold these 90 calls into end of week, you're done, right? Because you're going to finish out of the money and then you're going to have a big risk there, right? So especially if you're trying to hold for quite a good chunk of time into end of week and all of that, you have to be selecting a contract that should finish in the money in theory, right? So whenever you're looking at these targets, right, a lot of times I'll grab strikes that are a couple strikes, a couple nodes under, right? Another thing to consider is not only where the optimal target will be. So, right, best case scenario, we bounce off 80 to 90. Sure. But we need to also notice where are these other levels in the way, like potential gatekeepers that can reject price, right? So when I'm looking at this, I'm saying, okay, sure, 90 would be best case scenario, but it's very real, very probable that 85 will also reject price or at least stall price out, right? Because it has some decent volume here. So a lot of times what I'll do is I'll say, okay, I'm probably not going to play any strike actually that's from 85 up to 90, because 85 could potentially reject price. So I'm going to try to grab 83, 84, maybe something a lot closer to the money, where even if price rejects 85, I can sort of trim this contract as we reach it, right? Or if it chops a bit longer, some of this volume rolls lower, and then we only get a push to 85, the contract I have should still retain a lot more of its value, right? So you can still use the heat seeker, these maps to your advantage when trying to select some of those contracts, right? Again, the if you want to be really, really safe, sorry. So the other thing you can do, right? If you're trying to target, let's say you're trying to target upside here, right? But you're trying to do it in a safer way. What you can do, there's sort of two things you can do to get a safer contract, right? One is, oh, I drew this arrow the wrong way. Sorry. So one is if we're targeting 85, right, just to be conservative. Two ways to make the play safer, the trade safer. If we're playing the bounce off 80, the first thing you can do is buy a strike closer to the money, right? So you can go down the option ladder if you're playing calls, or you can go right? And you can buy more time. So these are the two ways you can get a safer trade, right? Obviously, they each have their own drawbacks. Like buying more time. Obviously, you give a little bit more cushion for the trade, the setup to happen, right? Like sometimes it stalls from Thursday, Friday of one week, and it happens on Monday, Tuesday next week. The big issue here is you're also allowing more time for external news to happen, right? In terms of, all right, market sold off. Who knows? Trump tweeted something. China says something. Like there's a lot of other just random factors that you can't account for. So the more time you buy, sometimes you're getting some of that to negatively impact you. But for the most part, buying more time is definitely a safer thing to do, right? Because if you're still buying strikes that are close, right? If we're expecting a move towards 85 this week and you have 85 notes next week, it's usually will be a lot safer that way, right? And like I said before, the other way is just getting a closer strike price for the same week, right? Um, so that's sort of always like one of the tips I always have is like, okay, if the trade you're taking looks a bit risky, or let's say you prefer to do it in a much safer way, try to look for a strike price closer to the money, or something that has a bit more time, right? Obviously, both of these are going to cost more than this itself, but this sort of the extra cost is worth it just to have a bit more healthier movement, right? And not having to be stressed as much as you're in this trade. Let me see here. Another thing I'll do from time to time. So let me just delete this. So when you're trying to buy some of these contracts, right? Another thing you can do is like when I'm trying to decide it, do I want it to be a 1 week, 2 week, 3 week play? A lot of times what I'll use is both the GEX and VEX maps in combination. Because if I see strong volume this week and next week, right? So for example, right now in ASTS, I'm not saying ASTS is a good trade, by the way. I'm just using this as an example. But the fact that we're seeing strong volume the following week as well tells us, okay, if I'm playing upside and I see strong positioning for the next week as well, then that might be a case where I buy calls 2 weeks out, right? Because I'm trying to capture more of the full move rather than just the initial move that starts this week, right? While if I only see nodes for the current week and I don't see any kind of volume going forward, those are cases where I'll probably just buy same week contracts, right? Because we're not expecting the move to go any further, right? Into the following week. So yeah, so the it's kind of two scenarios I'm stating, right? So the first scenario, the one I drew out previously, is like you're buying an extra week of time just as a bit of cushion, so your contract has healthier movement and doesn't suffer as steep, as wild of fluctuations in your P&L. But even if you buy an extra week, you're still planning to sell within the 1 week window if the trade is for 1 week, right? The situation I'm stating now is like, okay, if you're seeing nodes for 1 week only, then the time you're expecting to hold the contract will only be that week, right? Whereas if you're seeing a good setup and your bias is still holding into the following week or the following 2 weeks, maybe you buy an extra week or two of time so you can capture more of that extended move or longer term move, right? So hopefully that's clear what I'm trying to say there. Um, Okay, I'm trying to think if there's anything else I want to go over. This might be the majority of it. Oh, Morpheus. In this case, should expect chop or we still trade? Morpheus, what are you looking at? This has nothing. Morpheus, can you tell me what ticker that is and what time it is? Actually, let me wrap up the session before I can answer that after. I'll just end the recording and then we can go over some of that. Are there any questions regarding sizing, contract selection, any of that? I will add contract selection for spreads is completely different. I'm going to do a session on spreads, probably in collaboration with G Notes at a later date. So, for spreads, selling options, all of that, you're still going to need to know a lot of this stuff, just in a very different, it's a lot of different targets and all of that. Everything I've said so far is assuming buying options and assuming you're doing trading a similar style as to what Glitch teaches in the majority of his YouTube videos. Is there a range? Oh shoot, everything. All these questions came in the same time. Uh, okay. Is there a range I like for IV? No, the general rules I use is under 100%. Um, on the indexes, actually, 100% is crazy. Like you very rarely will see IVs that high. I think high IV on indexes is towards like 40, 50% even. Um, Yeah, so I guess I've never thought of that test too if I'm doing like a lower side. But for me, it's generally if it gets too high, that's a concern. Anything else, I'm comfortable trading. But again, the IV fluctuates a lot by ticker. So it's some tickers naturally will have very high IVs and some don't, right? Pocket 5% is aggressive. It can be aggressive, right? So 5% is like once you have your set system, you know you're consistent and you're already in the like have gone through that whole testing and learning phase and you're very repeatable, right? So like I said at the beginning, if you're new to something, especially this, you're not risking that much ever, right? Like you're risking very small amounts, as small as you can while you learn. This is more so once you already have a lot more consistency, a lot more confidence, and you know you have that edge and it will show through, then you can start sizing a bit heavier, right? And also it's like it's also portfolio based, right? If you're trading 10K, 5% is $500, that's probably fine, right? If you're trading $1 million, you're probably not going to be doing 5%. You're probably going to be doing a bit smaller, towards 1%, even smaller than that. So it's um it's also geared probably more towards like the mid to low side portfolios where you can be a bit more aggressive with it. But as if you're managing very large sums of capital, you're probably not going to be that aggressive. Um, yeah, PK, I'm going to do spreads. I messaged Genos about it, so it's on his radar. I need to talk with him and sort of organize the points we want to make and see how we're gonna collaborate to do that. Uh, can you show the risk reward ratio, Barracuda? Barracuda, is there a specific example you're looking for? Like risk reward ratio is always going to vary based on the individual setup. So I don't know if I misunderstood that one. Morpheus, I can DM that to me. I'll check after. Uh, okay, Spectra. Yeah, I'm glad it helped. As like I said, right? For anyone who's a bit, I see a few like newer names in the group in here. So for any of y'all, make sure you're sizing way, way smaller than what I mentioned, right? Like try to size the minimum you can while you're still coming to grips with the tool. And then later you can sort of slowly ramp up your sizing as you are comfortable with it. What else do we have? Wait, there was a question I missed here. Oh, Admiral, when do I not enter positions at all? When do I not? I mean, I guess that's setup based, right? So that's a bit different to what I'm going through here. If I just don't like a setup or I feel concerned for some reason, then that's when I'm not taking the setups. And then in terms of like chasing or entering early, right? I almost always wait for nodes to tap themselves, so I don't take the early side of the entry. You can, like, it's perfectly fine to do so. Like SPX has a buffer of plus minus 5% or $5. I always take the node itself or under. Uh, Sorry, not under, or the overshoot. so the cheaper entry. Plenty of people take the more aggressive entry. It's just I prefer not to because I know it. I used to, and it would give me a bit of problems, like mentally, not actually like setup wise. But yeah, like that question, Admiral, is more like a setup dependent thing actually. So the if the setup's not good and you don't want to trade it, then everything I've gone over here doesn't really matter, right? It's just not something you're interested in. Blair, it's not yet, but it will be eventually. Donald. Oh, thanks, man. How's it going? Didn't know you were in here. I was watching your recap today. I need to finish it later. I had seen on Twitter I was watching part of your call out in your server. Barracuda, what is the risk reward on the setup I just did? Oh, I don't know. I mean, this one it would be a trade-off 80, so like I'd have to check the chart and everything for like where I would put like how much risk and reward and whatever. But this setup to me is junk. It's not really a good one. Probably like it sold off pretty hard. I haven't even looked at the chart, right? So I don't want to say anything there. Oh, I see what you're saying. How do you calculate? Yeah, so in theory, you're targeting, okay, in this case, right, what I would always do is your reward is actually not actually the full move. You'd want to be basing it off of the um or at least what I do, right, is I base it off like the potential gatekeeper that could grow in the way, right? So I'll probably be basing this move at 80 to 85 pump. And then the risk, there's a couple of rules here. Like most people use one or two nodes as their risk. But again, it depends on the ticker, right? Like I know Rigetti, like I used to trade Rigetti a lot, right? And you cannot use one to two nodes on Rigetti. Like that thing will overshoot three, like it will overshoot steep, right? Before getting that wick back. Um, so in cases like that, your risk has to be a bit wider. But for more stable tickers, right, you can usually just use probably a couple nodes as your risk. Um, but it also matters. Are you playing a reversal off of a positive node or a negative node, right? So I think Barracuda, I think you're quite new to the group, so this is something you'll probably learn with a bit more time. But negative nodes obviously have a higher tendency to be volatile reactions and wick pretty steep under. So a lot of times with any kind of negative node bounce, whether it's to the upside or downside, I'm giving it a lot more leeway, right? One, I'm trying to get a cheaper entry on it, but two, I'm giving it a bit of a wider, like stop loss or like level where if it breaks that low, I feel like the trade is invalidated. Whereas on a positive node, I'm a little bit tighter on that, right? Because we usually expect those to be a bit more suppressive to price action and not really get these huge wicks past, either overshoot or undershoot. So hopefully that covers what you meant, Barracuda, or covers your question. Oh, Admiral. So if the options are too expensive despite good setup. Oh yeah, so I've had that happen a lot, right? Like so for example, Netflix pre-split, Costco, if you're looking at a setup that looks great on the heat maps, the chart, and you go pull up the option chain and that thing costs $500, $1,000, and your port is 5K, just skip it, right? Like what I do is I paper trade it and I say like, okay, I still want to see what's the end result, but this is not something I'm going to risk capital on because it's outside my risk parameters, right? Same thing for SPX. That's a huge thing with SPX. Like I know Glitch trades SPX. A ton of people on the server trade SPX. If your portfolio is not big enough to trade SPX, or like your trades are only a single contract, there's very little point in trading SPX, right? Because I know the gains may be a bit higher, but you're so limited and you're not able to trim positions and leave runners that it becomes almost useless, right? So it's better to just say, I'm going to trade SPY for now, grab 3 to 4 contracts. I can actually scale out partial and leave runners, and you're able to manage your trade in a much healthier way. So that flip to SPX should really only be once you're able to buy quite a few contracts and actually trim and scale and leave runners properly, right? Real Donald Pub trying to make recaps with Heatseeker and TA. Yeah, that's a good point. Uh, Real Donald Pump. I'll check your video out later. It's gonna be like at 2 a.m. or something, but I'm gonna check it out when I have a bit more time. I might text you about that because yeah, I've been trying to do a bit of that, but Yeah, I'm just really bad about like posting content. Like I just have the YouTube and I don't really use my Twitter. Um, but yeah, so I may message you about that. Morpheus, yeah, I'll take a look at that. Again, DM me. Yeah, if anyone here has like more individual, more specific questions, feel free to DM. Cool Alto, why does VIX only have Heatseeker map for next week starting? What? I think VIX only has monthly expirations because VIX expiration is on Wednesdays. Yeah, so if you notice, like OPEX is on February 20. VIX actually expires, I think it's on Wednesday mornings, right? So VIX expiration is the 18th, and it's every month, so that's why that's the case. Cool Alto. Blair said, "What TA?" For Donald Pump. I think there's news pre-market. I'm not. I don't even trade the first 30 minutes, so I'm probably not the person to ask. You have to ask John. John is a lot more comfortable trading the early morning stuff. um, yeah, I think the last thing I probably should have gone over, but I guess I probably won't, is you can also scale into trades the same way you scale out. I think I'll leave that for a different session, just because for now what I'd recommend is just take the safe entry and take a single entry, especially if you're still learning, right? Just take that safe entry, single entry, don't average down, um, and that's probably the approach you want to use. But for people with larger portfolios, that is definitely scaling in is something that people will use at those levels. But yeah, I'm not going to cover that here just because